Business owners likely will have only one shot to sell a business. Most don't understand what drives value and how buyers look at a business. Until now. Welcome to the How to Sell a Business podcast, where every week we talk to the subject matter experts, advisors, and those around the deal table about how to sell at maximum value. Every business will go to sell one day. It's only a matter of when. We're glad you're here. The podcast starts now.
One of the industries that business owners are most emotional about is the pet industry. And the funny thing is, the people that are passionate about animals are really passionate. And it's really unique to find a deal maker that specializes in just that. Pet-related businesses. Well, I found her, and her name is Erin Fenstermaker of the BirdsEye Advisory Group. And they have an investment bank, and that's what they focus on, 100% all pet-related businesses, from manufacturing to distribution. I don't believe they get too far into retail, but they are into professional services. And so what we're seeing, and in our conversation, it was really interesting to visit about what's going on in the industry, because it really tends to be recession proof. And their practice, they're killing it, and they are not seeing any kind of bumps in valuation. If anything, it's just the opposite. So today we had the opportunity Erin and I visited about, just what you need to do in order to prepare your business for sale. What are the metrics within the pet space that really amplify value? So I hope you enjoy my conversation with Erin Fenstermaker of the BirdsEye Advisory Group. Well, Erin, welcome to the show.
Thank you. Thank you for having me, Ed.
Well, I'm delighted to have you. One of the pet industry is always an industry everyone likes to talk about. Mm-hmm. Regardless, anybody that has a pet knows that there's a big, big industry behind it. So I guess where I want to start first is to talk a little bit about your practice and the things that you're focusing on in the industry.
Yeah. So I work for BirdsEye Advisory Group. We are a boutique investment bank specifically in the pet industry only. That's the only vertical that we work in. So that's a little bit unique in that respect. And then within that, the pet industry is a $100+ billion industry. And it includes, veterinary services, and then let's say hard goods. We actually specialize in the hard good area, not services and veterinary. So that kind of narrows down at least a little bit as to where we specialize. And my personal background, I've been in the pet industry about 20 plus years in various capacities. So, I happen to be a certified dog trainer, but I've also worked in both marketing and operations in a lot of different businesses, both pet and non-pet. And all of that combined experience really has translated well in the M&A world. I happen to focus, my work tends to focus on, I create the marketing book. They call it the CIM, the Confidential Information Memorandum. I put that together. That is also the first level of due diligence that a banker is doing with their client. We're looking under the hood to make sure that that everything looks good, or if there are some issues that we address them prior to going to market. So, I focus both on the marketing side on the front end and then on the back end with due diligence. Nice. To me, that's where the details are. A lot of the meat is in there. A lot of the problems might also be in there. But it's where I feel the most comfortable.
well, that's awesome. Since you're writing the Sims, let's talk a little bit about kind of the state of the industry, mm-hmm. and where we're at and where we're going.
Okay. Yeah, it's actually been a really, really interesting last few years. I mean, obviously the pandemic has impacted most industries in one way or the other. In the pet industry, you may have heard reports about the increase in pet adoption. All of those things are true. But if you look at it a little bit more closely, while the pet industry was growing at a higher rate during the pandemic, it actually hurt the service segment of the business pretty dramatically. So people that had grooming businesses, dog daycare, pet sitting and dog walking, those businesses really took a hit during the pandemic. But conversely, the pet treats and hard goods and food all did phenomenally well. So while in general the industry grew very well, you have to really kind of dig in to look at the different segments of it and see that there was some pain for a group of the industry, but the overall industry, grew at about 10%, I believe, during that time frame. And now we're pretty much post-pandemic, knock on wood, and the services segments are recovering. So that is great to see that they are back in business and doing well.
Well, we had seen that there was a lot of consolidation, after COVID. Is that a fair representation of, especially on the service side? Is that what you guys saw or no?
In some segments, yes. There are some service segments that are, I would say, easier to consolidate than others. So as an example, the veterinary space has seen a lot of consolidation. And for the most part, I think that's been a really good thing for that segment. You're also starting to see consolidation within the boarding market.
Oh,
and again, it's not as mature in terms of the level of consolidation as maybe the veterinary space, but boarding is probably the next frontier. But then there's others like grooming and dog daycare and pet sitting and things like that are going to be much harder to consolidate, if at all.
Right.
So we'll have to see how those segments fare over the next decade.
Yeah. Well, one of the things that really surprised me was seeing private equity getting into the vet space. And, a number of, not only friends, but also, just here in the community, PE was picking up some practices, which I don't want to say surprised me. It just, you don't think of private equity moving into the vet space. So,
but if you actually if you dig into what vets actually do and where there are economies of scale and extra profit margin to be gained that a single practice can't take advantage of, you think about, buying power as an example. So if you have a group of practices that are buying medical related supplies and prescriptions and things, obviously their buying power is greater if there's more of them together. The same thing happens with marketing and advertising. So if they need to do marketing and advertising, typically vets aren't known for being the best marketers. Right. So it's much better if you've got a more polished organization that's leading that for a bunch of different practices. So if you actually look closely into what vets were doing, it made a lot of sense, as long as the private equity firm had some of those capabilities, as part of their group.
Right. Well, the funny thing that I shouldn't say the funny thing, it's growing more alarming. And I don't know if this is true. You'd know more than I, but in that vet space, there's not a lot of vets coming out of school to acquire these sole practitioners. Are you seeing the same, or am I wrong on that?
Yeah, in fact, one of the things it's not actually very well known outside of the pet industry in general, but there aren't the number of vets coming out of vet school these days as there were previously, and definitely not enough to support the growth that we're seeing in the pet industry. And if you think about what a vet does day in and day out, and you think about one of the areas that is reaching a crisis state is really the mental health of veterinarians, because they're seeing huge volumes of pets And they're seeing them usually when they're not at their best. In many cases, there's, there are sicknesses or accidents or what have you. They're having to perform euthanasias on a regular basis. Those things take a toll on any human being. And, you take that fact and then you multiply it by there's this huge surge of more clients coming in. It makes it very difficult to be a vet these days and stay healthy and happy.
I had no idea, and my wife's a therapist, so it's it's funny you say that, because I you would think I would be attuned to those types of things, but
it's really the convergence of a couple of factors impacting in a negative way, and so I think about it a lot when I go to the vet, because I know how difficult, on a personal note, I have been on the board for a shelter, and so I know the day-to-day things that happen to 120 animals, and they're gut-wrenching. And that essentially is a very similar experience for what a vet is going to see on a daily basis. And so you have to have a certain constitution to be able to do that and still maintain a good mental health state.
That's a great point. And again, so what's the solution? I mean, or do you foresee a solution on how is that going to correct itself? I mean, because you certainly people are going to continue to have pets, but who's going to treat them? You know what I mean? Or how?
It's a great question. It's not an area that I happen to where I would even say that I have expertise. I'm aware of it, but I don't know enough about to me, it has to start on the appeal of the veterinary practice in general. And, whether it's how much income that they're making, because unlike a human doctor, they don't make the same financial return that a human doctor does.
Right.
So I don't know if that's going to translate. Then eventually, prices are going to have to go up so that more people are more interested in becoming vets.
Yeah.
And to me, that's kind of the obvious possible solution. But I would hope that there's other ones as well. I just don't happen to know what they would be.
Well, and that may explain, the sophistication of the private equity getting into that space, because they recognize that they're, the long play is that, we're going to have to increase prices. We increase prices, we're going to increase profitability and therefore increase valuation. And that kind of takes me to where my next question was, as it relates to value. It's really interesting about some of the profitability of pet related businesses, because again, I think a lot has to do with the emotion, like my dog. I mean, I love my dog, and I was always a tough guy. And I said, I budgeted this much for that dog this year, and we go over it, and I'm not paying more than whatever, $500 for the dog. And now, he's part of the family. I would pay.
Yeah, that goes out the window, because they are now your child.
Right? That's exactly it. And so as it relates to value, these become, and rightfully so, they are some of the more profitable businesses that you see. So anyway, I wanted to talk about, I know your practice, you have kind of a broad practice of who all you serve. So I'm just kind of curious to know, from a valuation standpoint, are the multiples staying static, or, are we seeing a bump? Where are we in the value world?
Well, I'm happy to say that the pet industry is alive and well and thriving from a valuation perspective. I would say we've seen some of the highest multiples over the last 5 years. I do think that right now, with the economy softening to some degree, there's less deal flow, so there's less people that are wanting to take their shot now to sell potentially. But if you have a good company, there's always going to be a buyer.
Right.
People are just falling all over themselves trying to get into the pet industry because it's almost considered recession proof and,
Right.
just keeps showing great returns year after year. So, it makes a lot of sense that it's attractive to a lot of financial groups. But in terms of, the other thing to think about in evaluation terms when it comes to the pet industry is there is quite a bit of difference based on the type of company that you are. So
Right.
as an example, a hard goods company that sells, beds and leashes and harnesses and things like that tends to trade in the lower range than a consumables company that is, food or treats. So, depending on what product line that you chose
Right.
to enter into, that's going to affect to some degree what your potential exit is going to be. The other thing that's also really important in our industry that affects valuation is whether you're a branded product or whether you're a private label product. So a branded product is going to be higher valued than a private label product. So when we counsel different businesses about, what we think their valuation is going to be, people get a lot more excited about a branded business than they do a
Sure.
private label business. So, so they can make the decisions that they are going to make, but they just need to be aware of what what the impact might be. And then I also think, another area to consider, is your revenue size, because, once you get past 20, 30, $40 million, the multiples are going to go up as well because of the
Sure.
size of the business. So
Yeah.
you can be a treats company today and be 5 million. And then, there's another one that's 50 million. Well, that one's they're both treat companies and maybe they have the same profitability, but at 50 million, they're going to get a higher multiple.
So they're going to get a higher multiple. And that's where I want to poke a little bit on the types of buyers. Who are the types of buyers at these different price points? Can you talk a little bit
Yeah, that's
about
a great question. So, there very much are tiers where different buyers come in.
Yeah.
So, in the pet industry, what we typically see, if you're under a couple of $1 million in revenue, there aren't going to be very many buyers for your business that are a strategic buyer or a financial buyer. It's most likely going to have to be somebody that wants to run a business and will buy your business for that, for that purpose.
Uh-huh.
Once you start hitting about $500,000 to $1 million in EBITDA, that's when you're going to start potentially gaining some interest from some strategic buyers. Strategic buyers being those that are already in the industry and see some sort of advantage that they would have for buying you, whether it's you have a specific product they want, or maybe you have a customer set that they would like to also get into, or maybe it's the personnel, whatever it happens to be.
Sure.
But strategic buyers tend to start being interested at that level, but very few financial buyers get interested at that level. There are a few, we know of some that might look at a business that's 500,000 to $1 million in EBITDA, but there's not very many. So, if you want a really healthy pool of potential buyers, that really starts at about 2 million in EBITDA.
Okay.
And at that level, there are a lot of both strategic and financial buyers that we could potentially, show your business to, at that rate. So you kind of have to go up those tiers to get get more attention for your business.
Yeah. So where are those buyers coming from? Are those national players, regional players? Where do the $500,000 and up EBITDA buyers come from?
Well, typically, if it's a strategic buyer, it's almost always a national business in the pet industry. Again, I happen with BirdsEye Advisory Group, we focus on the hard goods and consumable space. So we're not talking about service businesses that are tied to a specific, let's say, local area. So, if I'm selling treats or collars or what have you, most of my potential buyers can be from anywhere. They could even be international, but more likely they're going to be a national, a national company. And then, the financial buyers are generally going to be private equity firms, and those also can be from all over the country. So when we go out to market with a potential business, it's almost always casting a national net and even an international one, depending on what they sell.
Yeah, and and that takes me to my next question on and what's the best way, and again, this is a tough question, but I'll ask it anyway. So on these different tiers, I mean, I know you guys have a really good success rate on this on selling, but I mean, as an industry as a whole, what, at the sub $500,000 in EBITDA, what's the likelihood they sell percentage wise? Because I mean, as a most businesses, what, 80% don't sell.
Mhm.
That's theoretical.
Yeah,
I mean,
when I got my exit planning certification, I think they told me 70%, but it was remarkably high,
whatever.
and not in a good way.
Right, all right. So in this industry, I mean, because my next few questions is how to fix that. And so, I mean, does that stand true? Like the smaller businesses, there's probably a 70% chance you're not going to sell, and as you move up, it improves.
Yeah, I mean, if you look at it, I come from a consulting background also. So if I had a client that was $500,000 in EBITDA, usually they're at $500,000 EBITDA for a reason instead of at $2 million in EBITDA. Whether it's not the right personnel, maybe their pricing is too low. It really depends. What are they doing incorrectly to not, be experiencing a higher growth rate? So to me, if you're going to be that small in the litter box that we play in, to use an industry pun,
in the litter box, that's great.
There's probably a problem that needs to be addressed or corrected in order for them to be more appealing. That doesn't mean that there isn't a potential buyer. It just means the pool of buyers again is shrunk, and typically at those levels, they're probably going to have to use a business broker. Does a business broker have a network of contacts that have experience in these industries? I mean, it really does. My business partner at BirdsEye will say, that the pet industry is like the mafia. It's very hard to get into, but once you're in it, you don't want to leave.
Agreed.
And so if you don't have experience in the pet industry, it's very difficult, to come in and be successful on day one, running whatever the business is going to be. It's just in our experience.
Yeah.
So, how to increase? The first thing I would do is look at what are you doing wrong? If you're under $500,000 and maybe you're growing, but maybe you don't have capital or something like that, got to solve the things that aren't getting you to those higher tiers. You have to really look at your business from an objective way.
I got it. So what I hear you saying is that your first step in making your business more saleable is critical mass. That you have to be a bigger business that's going to attract a larger pool of buyers.
Mm-hmm.
I get it.
And if you think about the reason why that's important, because I always was like, well, why? Why does that matter? Well, because if you think about it, the cost of a due diligence process that a buyer is going to undertake, that's a strategic buyer, a national company, it's going to cost on the low end $500,000, and on the high end $1 million to $1.5 million. So why would they spend that on a company that is that small? So they need economies of scale to make that investment in the due diligence make sense. Yeah.
Well, and that's a great segue. So and by the way, swinging back to in the litter box, that would be a great podcast.
There probably is one already within that, right. Or there will be tomorrow.
In the litter box. So you were talking about due diligence. How do sellers in this industry survive due diligence? What I mean, because I'm certain you're like you said, you do consulting in this. So So how are you consulting to these types of sellers, saying, all right, everybody says you got to have clean books and records, but specifically in this industry, where should somebody spend some time looking?
Well, I would say the number one pain point for any due diligence process is the financial due diligence. And so it's their accounting and record keeping. And I could line up 10 business owners in this industry and say, do you think you have adequate bookkeeping and accounting? And all 10 will say yes. and probably the bulk of them aren't correct. You know, so this is, and where I think that changes is if you have a CFO on staff, whether it's a part-time CFO or a full-time CFO, that's when we start to see a lot more legitimacy in the answer that yes, they have proper accounting. Typically, because a CFO, not only do they have accounting background, so even if they aren't doing all of the accounting function, they can oversee what the accountant is doing. But they can also do budgeting and projections and do cash flow models and things like that. Things that really are necessary for a business that's moving out of being small into a medium-sized business. Yeah. I would love if every company that we ever sold had a CFO or at least a part-time CFO, a minimum of 12 to 24 months before they sold, because everybody thinks that they are adequately prepared and the bulk of them are not. And they don't know what they don't know. And so that's the hard part is trying to convince a business owner that the way that they've been doing it, while it might be fine for them filing their taxes, is not going to withstand a due diligence process.
Yeah. So are there any particular areas of the due diligence that you run into friction?
I guess a couple of areas come to mind. I have horror stories from things that we have encountered over the years, which is why I'm so adamant that this needs to be addressed. But I think, the first thing that we ask, is, are you able to run reports for a minimum of a 3-year look back period? Okay. And do those reports allow you to slice and dice revenue segments? So if I have 3 or 4 different areas of revenue, can I break them out in those ways? Can I also break out the cost of goods for those different revenue segments? And can I also do it on a product basis, a single product basis? You've got to have reporting that does that. And you've got to be able to look backwards at it.
I got it.
The other thing that's also important in that 3-year look back period is you need consistency across the years in how you're booking things. So as an example, if you had 2 different accountants during that time, and one of them is putting marketing expenses in COGS and the other one is putting it in operating expenses, well, then when somebody that looks at the 3-year period, it's not consistent because they're not following consistent principles. So you really want that to be all resolved and clean before you ever go to market. And usually for a period of 3 years or more is the ideal look back. And then conversely, projections. If you've never done projections before, which many of our clients, when we took them to market, have never done, that frankly is very risky because the 12-month look forward period is what most buyers are buying.
Right.
And so, and usually our sale processes take about 6 months. So, the first 6 months of your projections, you better be hitting those targets throughout the process. Otherwise, the wheels may fall off the process because you are not standing up to the numbers that you put out. So do you really want to make the biggest financial transaction of your life on numbers that you have zero experience in predicting because you've never done it before? You really need to have that sort of experience prior to going to market.
Yeah, you're from a valuation standpoint, that's certainly, the predictability of what's coming is certainly important. And that's really interesting that you bring that up, because I out of all these podcasts, no one has said you need to be able to, forecast what you're going to do. I know everybody asks for it, but as far as this is kind of mandatory for the likelihood of you selling and the reliability of you as a business owner and, as an operator of the business that you have.
Yeah, it shows how much you know your business. If you can't predict the future, at least in short-term intervals, to a reasonably accurate degree, then why should they believe any of the things that you tell them? That's really what your your forecast is saying. And if you've never done it before, I mean, what's the likelihood you're going to hit a bullseye on the first go around?
Right.
I mean,
no,
not that high.
Right. And that's funny because again, by you being able to understand or make your business more predictable, the less risk and the higher value. So that's
exactly. I mean, so if you as an example, we just closed a transaction about a week ago that took a lot longer than we normally. We have about a 6-month process. This took almost 12 months.
Yeah.
And I can tell you, every single month as the deal was going on, we were like, you've got to hit your numbers, or you've got to be pretty darn close. And fortunately for them and for us, they, while they had ups and downs, they were pretty darn spot on with where their forecast was. So fortunately, that did not derail the process, but that can, and it has derailed other processes in the past.
Do you see buyers often retrading?
Unfortunately, yes.
Okay. Well, but my question is, do they retrade based on a month, or they retrade because you missed it based on the year? And
that's a great question. So our goal, obviously, on the banking side, is we never want to retrade. And there are a number of safeguards that you can do to mitigate the likelihood of that. As an example, in the deal size that we're typically doing, we often recommend a sell side Q of E, a quality of earnings, be done. That can typically cost 50-ish, let's say on average, 50,000, maybe a little bit more for depending on who the firm is. And, we get a lot of business owners that hem and haw about wanting to pay that in advance. But if their books are suspect and they want a premium valuation, as in, I can even give a generic example. We spoke to a client who was doing about $16 million in revenue in the direct to consumer space. And we recommended that he do a quality of earnings because he was looking for a premium multiple. But we had some suspicions that his books just weren't going to do well under scrutiny. And so we said, let's mitigate that. Let's spend $50,000, find out what areas that are going to be the problem points, and point them out in advance and fix them if possible. But at least bring them to the attention before indications of interest and letters of intent get written. Because that nobody wants to have the retrading conversation, and a lot of times those things the retrades are preventable if you are transparent about whatever warts that there might be in your business. I'm a master at putting lipstick on a pig, as my mom would say, and in doing that in the marketing document, I can turn any negative into a positive if I know about it.
Right.
And I can position it accordingly. But those things that are found out during the due diligence process, if it's one, maybe you'll be okay, but you get a few, and then maybe you miss your numbers. I mean, it really, it kind of depends, obviously, on each scenario because they can be unique. But you don't want to have any surprises. You want to be 100% transparent so that you can control the narrative. And so that's what we recommend, to any of our clients. And in order to mitigate the retrade. And then if the company size and end result we think is going to be of a certain size, we say you can buy the security or the insurance policy by doing a sell side QV.
So how often are you seeing pre-sale QOVs being done?
I would say pretty regularly.
Oh, nice.
If you are this is arbitrary, but If the deal is, more than $3, $4, $5 million in EBITDA, it's not uncommon. It also depends too on what has the financial history been of the company in terms of, have they had a CFO in place for the last 5 years? Well, then you probably don't need to do one. Maybe you need to do one if you are a 2-division company and you're selling one of the divisions. Maybe that would be a reason, to do one. Size can dictate it. The lack of financial oversight for the history of the company can dictate it. The complexity of a deal, if it happens to be one division out of 2, those kind of things can really, it would be scenarios where a banker might recommend it.
Right.
We don't see it all the time, but we know that the buyer is going to do one in those scenarios. So if there's any possibility that they're going to find something negative, we think it's the best insurance policy against that. I mean, spend $50,000 so you don't get a $3 million or $4 or $5 million haircut on a retrade at the end. To me, it's a no-brainer.
Yeah, but it's funny you said it. So I had Elliot Holland from Guardian Due Diligence, and they're a Q&A company out of Boston, I think. And anyway, we were talking about that, and I was hoping that at some point we get enough empirical evidence where there is a case study that can be done that you can quantify that, you know what, if you do the Q&A, this either A, you're gonna pick up an extra turn on your multiple, something like that, where now you have, other than my experience is that if you do a Q&A, you increase your chances of selling, and the seller's like, well, I'm not spending $50,000 unless you got something. You got to come with me with more than that. And trust
me, I would love the same things because we just see the fallout if they don't do one. And we also try to, in some cases we've been fortunate enough and successful enough in some of the work that we've done that we're going to walk away from a potential sale transaction before we take the client on if we think that there's any possibility that the books aren't going to withstand scrutiny and the seller is not willing to do the additional investment in it, because we don't want to take the risk that we're not going to make our commission. So we have to be smart about it. And would I bid on this business knowing that they haven't done this work? It really makes you pause.
Right. And people fail to understand the reputational harm of bringing a business to market that, isn't
not ready.
It's not ready, or it's just unrealistic.
Yeah.
So I guess with the time we have, I guess I'm looking for what the podcast is how to sell a business. And I'm just curious to know, some high level guidance that you might be able to say, these are the things that in this industry that are specific to the industry that you have to do and you have to get your arms around. Well, I know we've talked about the financials, understanding the financials, but what other areas should a business owner start to focus on?
Prior to going to market? Well, it's a good question. I'm going to approach it maybe from a little bit of a different perspective.
Okay.
When I look at the companies that we've sold that have had successful outcomes, I look at what are the unique threads that I have seen about them that made those transactions successful. And the first thing that I would say, just kind of from a generic perspective, and this really kind of addresses competition in a sense as well, is, most of the people that have successful outcomes are successful because they're really passionate about whatever product that they're selling. They have a really good story about why they got into it and why they're doing it, why they believe it. And they've done a really good job of conveying that story. And you have to remember, the pet industry is highly personal. We're not selling, scissors or staplers or something. We're selling products for the equivalent of four-legged children. And so people want to develop a relationship with the providers of their goods, the goods and services, because these creatures are so incredibly important to them. So having a really strong connection with your end consumer, because of this, your passion and how you got into it, how you messaged it, all of those things, those are automatically going to resonate with the pet owner out there, because they're going to go, oh my, these people care the way I care. So those, you start with that magic that you don't need to look around and see what's the competition doing. I'm like, who cares? It really doesn't matter as long as you have the right product and message and you're focusing on how you resonate with your consumers. So the sellers that I think about, were really focused on who they were working for, and then, when it comes from an actual nuts and bolts perspective, when they actually came to the table, I would say that all of them were also, I've used the saying before with clients, if you were going to be in college and take a test, would you prepare? Hopefully, most likely. I know I was very, I wanted straight A's. I was going to study well in advance. So you have to think about the sale of your business kind of like the biggest test of your life. And would you show up to the biggest test of your life not having prepared? And people just think that they decide one day they want to sell, so they must be ready. Well, wait a second, they haven't even really looked at their business from a seller's from that angle, where is my business attractive, and could I withstand a due diligence process?
Yeah.
And most sellers, unfortunately, don't do that kind of homework. So the ones that have been successful are the ones that have decided, okay, I'm going to sell in probably 2 to 3 years, and they start making all of the right preparatory steps. They meet with their financial advisor, talk about, tax structures and potential, deal points that may be important to them. They start, if they don't have a CFO, they start working with a CFO, and they start doing projections. And, so they start doing the work to prepare for that giant test that they're going to take. They're getting all of their documents in a row. They're writing down processes for everything in their business. So the people that come to the table prepared in that sense are going to have the better outcomes than those that have done zero planning and simply thought, well, my business is good, so I pay me a high multiple.
Sure. No.
And also to the other side is most sellers, I think, because they may have had a lot of success in what they're doing, doesn't mean they're automatically going to be successful in selling their business. They have blind spots about that. And so this is where I highly recommend developing relationships with, several investment bankers to get some advice around, particularly those that have experience in your industry, and start talking to them 2 or 3 years before they are ready to go to market, so they can start getting an idea about what are the areas that they might need to shore up before they come to market. So, planning in advance to me is really is one of the markers of a successful exit. And I use the test example. It's the biggest test of your life. Are you gonna study, or are you just gonna show up? Sure.
Yeah.
And those that study tend to do better.
Yeah. Well, I agree, and in fact, I can tell you, over we've done 2,200 deals, and the common thread, and 87%, that if you do any value work, and I mean any value work, that you now understand the value and you understand what drives the value, you're going to sell, because now, like you just said, you now understand how a buyer is looking at it, how a financing institution is going to look at it. And so you're more prepared. But I want to circle back to your practice, because I know you do a lot of planning. So can you talk, I guess, how your practice works, and the consultative side of the practice? Because I know you do deals, but the people that hear this, they're going to say, all right, well, how do I work with her? And can you talk a little bit about just the practice in general, and who's right for you and who's not?
Right. So sure. So I'm a certified exit planning advisor, so I have my credential in that. And so, yes, I spend a lot of my time working on mostly sell-side transactions, but we do some buy-side work as well. But in my free time, I want to talk to business owners, particularly in the pet industry, because that's where we focus, that are planning an exit, let's say in 3 years or less. And we have a program that we call the Business Exit Boot Camp.
Okay.
And that is a process where it's a mini due diligence exercise, and it's a mini financial preparatory exercise where, as an example, I ask a business owner to provide me the last 3 years of historical financials, 3 years of projected financials, and provide any adjustments to EBITDA. And the ease or dis-ease that whole process takes just in that doing that preparatory work tells me a lot about where they are in their financial preparation. Then the rest of the boot camp is a series of interviews where I ask things from a buyer's perspective. So we talk about, how long they've been in business, where they are, what's their brand like, how are their gross margins, how profitable are, I ask all of these things. And then there's another series of questions and interviews that's around the due diligence side. So we do a deep dive into your HR practices and what product development do you have coming, and who are your key employees, and how are you protected in terms of IP related things. We ask all of these questions that would essentially be part of a due diligence process. And then we provide a score as to where they are on that today, and we provide valuation guidance. So we say, okay, we think that your business today is worth X, and that your valuation range would be between, these parameters. And then we give a series of recommendations. These are all of the things that we would recommend that you do to move yourself up that sliding scale to the higher valuation. And some of them are more short-term and quicker and easier to do, and others are much more complex and harder to do.
Sure.
And then obviously the owner is open to doing as many of them as they wish to do. But essentially it gives them a book that says, this is what I need to do to improve my valuation. And if I choose not to do any of these things, I at least know that, yes, they may lower my valuation, but I'm making that decision from an educated perspective versus being surprised about it, by just coming up to the selling table and not knowing. So it's a hugely advantageous process to go through. We recommend everyone go through it before they sell.
Nice.
We obviously can't force anyone to do it, but to me, it's a roadmap on how to run your business. If you want to add value and make your business more valuable, follow this roadmap, and you will get there. Nice. And then obviously from there, depending on what the guidance is, we can, if we have connections in some of the areas that they need assistance, we obviously are happy to make those recommendations. Because we are very industry specific, we do know a lot of people.
Yeah.
But it's, I recommend it for everyone, and it's hugely, I love these processes because I love to learn, what drove somebody to create the business that they did. Right. And also it's fantastic to be able to give them some really good information about how to do better. That they may not have looked at their business from this perspective. It's so valuable, and it doesn't cost that much, for what you get. So, I recommend every business owner go, whether it's through myself in the pet industry or through somebody else that is a CEPA. It's just a highly valuable exercise if you want to plan for your exit.
Nice.
Do an equivalent of a business exit boot camp, a couple years in advance, and you will be a lot smarter when you get to the selling table.
Nice. Well, I think you'll be close to my 90th episode. So, I ask this of every guest that's on, and that question is, what advice would you give to the listeners that would have the most immediate impact on the business? And I think I know what your answer is going to be, but nevertheless, I'm still asking the question.
Well, it's going to be around the financials. I hate to say it because it's not that exciting and sexy, but it's what I see over and over again. Yeah. My recommendations are, if you are going to go to market and you do not have a CFO on staff, at least do find a part-time CFO. There's a lot of programs out there that have fractional CFOs. I highly recommend getting one at least 12 months before you sell to start organizing your financials and finding any potential holes that there are, to start doing projections. It's an investment, but it will more than pay for itself by having a higher valuation. Nice. And assume, even if your bookkeeping and accounting has been fine for you all of these years, I also would add there, make sure that you identify an accounting team that has M&A advisory experience.
That's a good point.
Because if you are at least $2 million in EBITDA and are expecting a premium valuation, you're going to, you wouldn't want to show up at a gunfight with a water gun. You want to have if somebody else is doing a quality of earnings, accounting quality of earnings on your business, you want to have somebody that's representing you with the same credentials and same abilities. So identifying a practice, if you work with a small accounting firm now, I would plan 18 months in advance moving to a medium-sized accounting firm that has M&A experience. On that, it's going to cost you more, but it's absolutely the right move.
Good advice. So what's the best way we can connect with you?
Well, you can go to birdseyeadvisory.com. You can reach out to me on LinkedIn. We don't do the Facebook. And frankly, we are fortunate that
you don't have to.
We don't have to.
All right.
And plus, we're so busy that we don't have time to do it.
Nice.
But I would say LinkedIn or reaching out through BirdsEye Advisory is probably the best way to find me.
Okay, and I will put a link. I know I saw on your website the link to the boot camp. I will make sure that there's a link to that in the show notes.
Please.
So, Erin, thank you for your time. I learned a lot, and I'm certain our guests did too. So thanks for coming on and hanging out.
Oh, you're so welcome. I'm glad I could make it, and the pet industry is the best industry in the world. So if you can work in it, you are a lucky person.
I can sense the passion, and I, like I said, it is certainly an industry that is not going away. And so,
no, it is not. In fact, usually my pets on most meetings that I have, at least one of them will typically show up. Well, I'm surprised we've got a whole meeting without any of my pets coming.
Well, the funny thing is, so Dodger, my black lab, normally when a squirrel, I'm at my office, but if I'm in my home office, if a squirrel infiltrates the perimeter, all hell breaks loose, and that's when the editor has to work on it. So, well,
same with my when my dog if the mailman comes, it's all over. You would think Armageddon is happening over here.
Oh, right on. Well, again, thank you so much for being on, and I look forward to when we next visit.
Likewise. Thanks for having me, Ed. I really appreciate it.
Thank you for joining us today on the How to Sell Your Business podcast. If you want more episodes packed with strategies to help sell your business for the maximum value, visit howtosellabusinesspodcast.com for tips and best practices to make your exit life-changing. Better yet, subscribe now so you never miss future episodes. This program is copyrighted by MISO Inc. All rights reserved.